welcome back to Leah's Lifestyle. Today in book club, we're back in it again with Invested, Chapter 7, Charlie's Fourth Principle, Pricing. This is supposed to be July. Again, you guys can follow along with the week that we are in, or do July, do it by a year, whatever you want. This month, we'll be learning about pricing using whole company numbers, 10-cap pricing method, which has the owner earnings in it, payback time pricing method for formula for free cash flow, and widget growth rate. Without further ado, let's go. So the first thing that I marked in this was immediately Charlie Munger's fourth principle of investing, a price that makes sense and has a margin of safety, which is the last one that we'll be learning about. So I'm just going to put that in my notes because everything from underneath that will be about that. So I'm just going to say Charlie Munger's fourth principle of investing. And then under that, a little mark in a price that makes sense and has a margin of safety. And then the description of that is not to pay an infinite price for a company. Find the price that is reasonable and then still don't buy it. In other words, wait till the price is even lower than reasonable. Makes sense, is a price on sale, and has a margin of safety. So I'm just going to make a little mark underneath that for like the description and just say find the reasonable price. My pin is dying. That's okay. That's why we have more than one. Don't need that. Find the reasonable price. And then don't buy. And then a little mark underneath that. Oh wait, I'm gonna say don't buy. Wait till the price is even lower than reasonable. Wait till the price is lower. And then underneath that, I'm gonna make 4 marks. Makes sense. On sale. I guess 3 margin of safety. Okay, and then there's this question asked: will you walk me through a quick valuation exercise so I can see how you do it? And so I'm just gonna say down here, valuation exercise. And then he kind of goes through really quickly from his understanding. I'm just going to kind of read it. I made short little marks that we're going to take notes from, but I want to read the actual section here. Its EPS is $4.50, and the analysis growth rate is 13%. But historically for this company, that's really high. So let's make it 8%, because who are these analyses kidding? And then, using the rule of 72, that grows to about $10 per year. So, just wanted to make sure there was something there. The things we need to get from this exercise is EPS, analysis growth rate, and then in quotes I'm going to say find historical average, not just the years, what I want to remember, and then rule of 72. And now we're going to the next page. And she asks him, $10 of what? The share price? And he says, no, of the future earnings. So her question here, is essentially saying, you know you're lost when you can't formulate a question to describe something that would help you be less lost. So just a little reminder for everyone here. Like, as we're going through this, if you're going through it and you're understanding, you're hearing things that you know, you're like, oh, I know Big Four numbers, I know RE, I know ROIC, I know debt. But then you start hearing terms that you don't know. Take a step back. Lean more into education. Try and figure out what it all means first. Then there's a book that she brings up on evaluation that I think would be a good look into. I'm not sure if we're going to actually read it, because even in this book she says she doesn't fully read it or understand it. And it's 400 pages, and it's called Valuation. And so instead of like circle and read, I'm just going to leave little quotes here and say check out. And just make sure that I know it's important to really look at this and see if it's necessary to read. Because I'm not real sure. It is a book that she brings up, but even she doesn't read it, so I don't want to offer a book up for you guys to read if it's not. But some people, maybe the valuation book will be really helpful, so I still want to bring it in. And then she's talking to her partner, Nooney? I can't remember his name. Anyways, forget that this is even about math or formula. Use logic to get from where you are to where you're going, and then you won't need to get all worried over the math. You just need to understand it, and then it will come. My confidence is at an all-time low on this. Can you show me the easiest way to value a business that exists on the planet? If you can do that, I will figure out how to teach myself. So, in all of this, all the things that we've learned so far, I think it's a good moment to take in. That as you learn it, take it in, but then you got to learn how to use it for yourself. Figure out how your brain does it. So I'm going to write underneath the value exercise, I'm going to say, she says, easiest valuation. And make little stars around it so I know that it's the same thing but just a little different. And then we'll be reading these, but you can check it out. The next information comes from recapping Buffett's 2014 letter to shareholders. Buffett said to think about pricing a business like pricing a real estate purchase. It requires only a few numbers, all of which I had used when I bought my condo. We're going to write these down. Purchase pricing, maintenance cost, how much I would have otherwise had to pay in rent, taxes, insurance. So we're going to write purchase price, maintenance cost, just like I can understand why a Toyota costs less than a Lexus and why a Lululemon yoga pants cost more than leggings from Target. The same is true for some public companies, said Buffett. I used Buffett's example to start to learn my dad's 3 ways to price and value companies. Yes, 3 ways. So I'm going to write 3 ways to price companies. Or you can say 3 methods of pricing / valuation. 1, 10 cap. I just want to see here if I'm going to read them. We're going to write them down, but we're going to write them down and we'll take notes as we go along through each one. So, 10 cap price based on owner earnings. Payback time price based on free cash flow. Margin of safety. Valuation based on earnings. So, we're going to write 1, 10 cap price, and I'm even going to add in what she says based on owner earnings. I'll probably come back to that page to get the other ones. So, the notes for underneath the 10 cap. Buffett used a pricing method that real estate investors call capitalization rate, also known as cap rate. So I'm going to make a little note here called capitalization rate, quote unquote, cap rate. Essentially, a cap rate is the rate of return the owner of the property gets each year on the purchase price of the property, the rate of return being the money the owner puts in her pocket. For example, if I buy a house for $500,000 and get $50,000 in my pocket at the end of the year, the rate of return on my investment is 10%. That's my cap rate, 10. If I get only $25,000 in my pocket at the end of the year, then my rate of return is 5%, and that's my cap rate, 5. Basically, the higher the cap rate, the higher my rate of return. Buffett and Munger require a 10 cap rate, a 10% return on their investment per year, and therefore my dad calls the pricing method the 10 cap. Warren Buffett makes the calculation based on financial numbers he defined. Owner earnings, the amount of cash that can go into the business or real estate owner's pocket every year without affecting business operations. So, there's a bit here that we're going to write down. First, we need to have the understanding of what it is, the definition. So I'm just gonna write definition or def, whatever makes sense to you, and I'm gonna say two things. The rate of return being the money. Essentially, the rate of cap rate is the rate of return of the owner's property gets each year and purchase price of on the purchase price of the company. So rate of return. Let's say rate of return the owner gets each year on the purchase of the property. Slash the money the owner puts back or puts in their pocket without affecting business operations. Okay? And then a little note, look for at least 10% return. And then I'm going to say example, buy for $500,000 and get $50,000 in a year. 10%. Buy for $50,000 and get $25,000 end of year. 5%. Okay. The formula for the 10 cap then, I reiterated to make sure I had it right is owner earnings times 10. It tells me that the price I can pay will get me a 10% return from my first year of owning it. So we're going to write that too, to make sure we don't forget. Formula is owner earnings times 10 equals price you can pay that will get you 10% return for your first year of owning it. Wait a minute, a 10% return the first year? That's great. That's a great deal. How often do tin cap deals come around? That is the catch. You could literally wait 30 years to have a 10 cap rental building in New York for a farm buying opportunity like Buffett got in Nebraska. What is the point of the pricing method if the 10 cap deals are so rare? 2 points. 1, they do come along, and I've done some of them. Well, the 10 cap might be hard to find in real estate, farming, but in Buffett's 2014 letter, he goes on to tell you why looking for 10 caps in the stock market is a lot easier than finding them in your local real estate listing. Buffett was saying that the stock market moves based on other people's valuations and the resulting price they're willing to pay. Buffett was saying that the stock market moves based on other people's valuations and the resulting price they are willing to pay varies so much it is liquid. Because trading is much more susceptible to short-term emotions like fear and greed, and that creates many more buying opportunities based on your own valuation. Just because of that, investors who are not swayed by emotions can capitalize on regular opportunities to buy wonderful businesses at great prices. The 10 cap price was an anchor for me to know what an exceptional price for a company would be. Companies are not on sale at a great price all the time, but there are regular times when they are a deal. When there's a recession every 5 to 10 years, and when there's uncertainty in the industry or company. Whenever an industry is out of favor or an event happens, price drops, fear builds, and sometimes really good companies go on sale for a 10 cap price. The second reason to use the 10 cap pricing method is owner earnings. And owner earnings is the second way to price. So, flipping the page. And I'm going to go back because I know she said something. There was a note next to it. And I just want to make it. We're going to say 2. Boop. Oh, no. Payback time price. Owner earnings is a part of this. So I'm going to make a star instead so that we can continue. And I'm going to write owner earnings. That was a part of this one. Okay. Earnings. It is not provided on standard financial statements, but it is made up of numbers from those statements. It is going to give you the closest approximation to the funds you have available to you as the owner of the business without adversely affecting business operations. Owner earnings is allocated by the CEOs of Buffett's companies to maximize the amount the company can send to Buffett to invest. Owner earnings is about the cold hard cash that the business is producing right now, not in some foggy future. In his 1986 letter to Berkshire shareholders, what he says about owner earnings is the relevant item of valuation for valuation purposes, both for investing is buying stock and for managers and buying entire businesses. Since Buffett thinks it's such an important number, and because my dad feels all the feelings about the perfection of Buffett's formula, I'm going to put his definition down verbatim. Owner earnings represents A, a reported earning plus B, depreciations, depletion, amortization, and certain other non-cash charges, less C, the average annual amount of capitalized expenditures for plant and equipment, etc., that the business requires to fully maintain its long-term competitive position and its units volume. On a typical cash flow statement, net income is the first line under cash flow from operating activities. Depreciation and amortization, which is a non-cash expense to account for the declining value of certain assets, like the depreciation of a car, is the next number down. Still, in the same section, there will be a line or a group of lines about net change in account receivable, AR, and account payable, AP, from the previous year. Accounts receivable is when the business is owed money and its by its customers and accountants. Payable is when the business owes its suppliers money. As these numbers change year to year, the change either puts money in the owner's pockets or take it out. That is, it can be positive or negative. Each number indicates only that change. So, here is the formula. Net income plus depreciation and amortization plus net change, which is accounts receivable plus net change accounts payable plus income tax plus maintenance. Capital expenditures. And that will equal owner earnings. And so you use that to be able to find owner earnings. We also added the income tax that we find in the income statement because we are valuing a business the same way we value real estate, with our owner earnings before we pay our income tax bills. Maintenance capital expenditures is the tough number here because Mandling companies are not required to separate it out from total capital expenditures, usually called purchase of property and equipment. Maintenance capital expenditures represents the money spent on the long-term stuff that has to be replaced just to keep the business going. In a business with well-kept financial statements, the number for maintenance capital expenditures will be described in the cash flow from investing activities, notes to the cash flow statement. However, since many companies do not break out maintenance capital expenditures in their notes, we have to understand the business well enough to estimate the average annual cost. So I'm just going to make a little note here. Some companies / most do not separate maintenance from capital costs, capital expenditures. We must know the business well enough to estimate. Worst case, I use the full purchase of property and equipment number and take note that it is a large number, a larger number than it should be, and that I may not understand this company as well as I should. So, worst case, you just use the whole things. Best case, you understand the company well enough that you can make a good enough judgment. Then the book kind of goes through some fake companies that they've brought up in the past, the lemonade stand, working with Whole Foods, other things like that, and they kind of explain it a little more in depth. So definitely read the book for that. But we're going to move on to number 2, which is Pay Back Time. And this one did have a note in it in the back, so this is the one I was looking for earlier. Based on free cash flow. And if you already wrote it down, that is okay, but I'm writing it here. The payback time method is used by investors to put a price on a company that they are not going to sell for a long time. I'm going to make a mark for companies not sold for a long time. Payback time is just what it sounds like, the number of years it takes to get your whole purchase price back. Little star, and number of years it takes to get your whole purchase price back. Okay. Free cash flow grown by the compounded windage growth rate for 8 years. Oh, wait. Why did I make that? Because that's the formula. We'll explain soon, but first the payback time formula. I didn't mark that for some reason. That's weird. I should have. I think I was tired when I was doing this. That's okay. Alright, formula. Free cash flow grown by the compounded windage growth rate for 8 years. Then I'm going to actually read this example so you guys can get it, because I think that will be smart for you guys here. So in this example, they're talking about rental houses. And it goes, the rental house is in a nice spot, probably by the beach somewhere, where more and more people want to live. Rents typically go up in growing towns 3 to 4% per year. While my expenses would roughly stay the same, I wanted to be conservative, so I made its windage growth rate 3% per year. I multiplied each year's free cash flow by 100% plus the windage growth rate going out 8 years and found the 8-year payback time. And so she has the year, the free cash flow that it would be bringing, which is about $24,000. The year I bought it, $24,000, 3%. Expected would be $720, and then she added that onto for the next year, so it'd be $24,720, and then 3%, and that was $742 added, and so she added that back into, and it was $25,462 for the second year, 3%, $764, and so on, so on, so on. And by the end of the year of 8, it was $3,402, and it looks like she said cumulative free cash flow and payback time price by price. And that just looks like so each year I see what's happening. Do I? Maybe I don't understand. We're going to continue. Why is 8 years of magic number, Uncle? Why is 8 years the magic number? Uncle Charlie thinks a fair price is about half of what the same company would sell for as a public company, and public companies sell for about 12 to 20 years of free cash flow, about 16 years on average. Half of 16 is 8. If I can theoretically get my money back from free cash flow in 8 years, that's a pretty good deal for a wonderful business. So I'm going to write if you can get your money back in 8 years with free cash flow, that's a wonderful business. Oh, now I understand. So back here, on the reason why I didn't say anything, on the back here, the cumulative free cash flow and payback price, it went zero the year they bought, first year 24,720, and then 50,008. So they're adding 24 and 24, or 24 and 25. So that makes sense. So this number over here is just the cash flow of that year that they got back plus the 3%. And then the cumulative shows everything that they got. So at the end of 8 years, she got $219,819 back. Okay. Now onto free cash flow. Compared with owner earnings, free cash flow is crazy simple. Here's the formula. So we're going to say free cash flow, star free cash. I can write cash. Come on. Formula. And that is net cash provided by operating activities plus purchase of property and equipment. And it says a negative number. In the parentheses things. And then any plus any other expenditures and maintenance are for maintenance and growth. And then underneath it says also negative number, and that equals free cash flow. About 1/3 of the way down on the cash flow statement is a bold line called net cash provided by operating activities. Below that is the section titled cash flow from investing activities, and in that section it is usually a purchase of property equipment line. On almost all cash flow statements, this number includes all the capital expenditures, maintenance, and growth. There are 2 lines, one for growth capital expenditures and one for all the rest of the capital expenditures, which we can assume is the maintenance capital expenditures. Remember, these capital expenditures numbers are negative, so we add them as negatives to the net cash provided by operating activities numbers. The result is called free cash flow because you're minusing from whatever the net cash that they are bringing in. Time for the third. Yay! Oh, I don't have space here, so we're moving on to the next page. 3. Oh, wait! This is it. Time for the third. Margin of safety. The margin of safety would value the entire company, not only put a price on it as the first 2 methods had done. And then it just ends there. And we move into our July practice. So actually, I'm going to put the practice here, which are this week's practice. Choose 3 companies you like and calculate the 10 price and payback time price for each company. Reward yourself by bragging to someone who will appreciate it that you just used Buffett's special calculation of the own earnings. So for homework, and if you already are working still on those 3 companies from before where you're supposed to evaluate the moat, management, and I can do it. I can find it. We're taking so many notes. The understanding, moat, and management, if you're already still working on those 3, then just do those 3 with finding the 10 cap price and the payback. So, 3 companies, find 10 cap and payback. Brag. Alright guys, well, outside of using those 3 companies that we've already been practicing, for me, it has been with, I'm still working on it, so hopefully you guys are as well, but it's been with Hasbro and Nintendo, Razer, Hoka, and Brooks. More than 3, but it's your choice. Those are the ones I'm working on. Don't forget to also read Chapter 8. And then next week we'll come back and we'll go over Chapter 8 notes and find out the next homework together. So don't forget to work on that. And leave a like, share, hit that bell icon so that way you know the next time I'm going to post. And comment down below. What are the companies you're working on? How is that going for you guys? Are you able to keep up a little bit? I know we're moving a little fast here, but I'm just kind of curious how everyone's doing if you're finding this. Until next time, guys.